So you want to buy a space company, a rocket on the pad, a satellite in orbit, a logo on the side of something that literally leaves Earth. That sounds like the kind of business that prints money, except it usually doesn't. Because the real product in this industry is not the rocket. It's not even the satellite. It's the long, painful, expensive ability to survive long enough to turn capital into recurring cash flow. And that is where the entire space business gets misunderstood. The part everyone gets wrong, most people think the space industry is one giant engineering problem. Build better rockets, launch more payloads, win more contracts, get rich, that sounds clean. That sounds logical. That is not how this business works. Space is not just an engineering game. It is a capital game, a government game, a timing game, a trust game, and above all, it is a cash flow game. Because in space, the hardest thing is not lifting something into orbit. The hardest thing is staying alive financially after you do it. Here's the first thing you need to understand. A space company can have world-class engineers, a revolutionary design, strong demand, and still fail. Not because the idea was fake, not because the market wasn't real, but because the money ran out before the company reached scale. That is the central trap. And it is why so many space companies spend years looking impressive and then disappear almost overnight. Why this industry is so expensive. Space companies are built on brutal economics. You need factories, you need testing, you need launch infrastructure, you need compliance, you need insurance, you need engineers who are not cheap, you need hardware that takes months or years to build, and you need to do all of this before the business becomes truly self-sustaining. That means the company is burning money long before it is making enough money. This is why people in the industry talk about the valley of death. It is the gap between promising technology and real commercial survival. In that gap, companies do not die because the dream was bad. They die because the runway was too short. They ran out of cash, and in space, cash is oxygen. No oxygen, no mission. Why governments matter so much. Here's another thing most outsiders miss. The space industry is not powered mainly by random consumers. It is powered by governments. NASA, the US Space Force, the Department of Defense, the National Reconnaissance Office, European agencies, allied national space programs. These are not side customers. For many space companies, they are the anchor customer. The reason this matters is simple. Government demand is often more stable than commercial demand. A commercial customer may delay a contract. A government may plan a mission years in advance. A consumer may cancel. A defense agency may need the capability no matter what. That stability changes the economics of the whole company. If you're trying to build a launch provider, a satellite network, or a space systems company, one long-term institutional contract can do more for your survival than dozens of small speculative deals. Why? Because investors love predictability, and governments create it. The real business model, people hear space company and think one-time launch payments. A rocket goes up, money comes in. Simple. But the most valuable space companies don't work like that anymore. They try to turn hardware into recurring revenue. That is the deeper shift. Launch the satellite, build the network, sell the service, collect monthly or long-term payments. That is the model investors understand. That is the model markets reward. That is the model that makes a space company worth something far beyond the metal it launches. This is why satellite internet, Earth observation, defense communications, and data services matter so much. The rocket is not the business. The rocket is the installation cost. It gets the asset into position. Then the company tries to monetize the asset for years. That is a completely different economic engine. A one-time launch fee is a transaction. Recurring service revenue is a platform, and platforms are what create massive valuations. Why recurring revenue changes everything. A company that sells launches lives from mission to mission. A company that sells connectivity, data, bandwidth, monitoring, or intelligence access can generate revenue every month. That changes valuation, that changes investor perception, that changes capital access, and that changes survival. If a company has subscribers, contracts, renewals, and long-term usage, the revenue becomes more predictable, and predictability is gold. A business with recurring revenue can raise money more easily. It can plan hiring better, it can forecast cash flow, it can support debt or equity financing on better terms. It can survive temporary bad quarters without looking like it is collapsing. That is why the space industry has been moving away from pure hardware economics. Hardware is necessary, but hardware alone is not enough. The real prize is long-term customer dependence. Starlink changed the mental model. If there's one example that changed how people think about space economics, it is Starlink. Most people still describe SpaceX as a rocket company. That is outdated. SpaceX is also a connectivity company. It is also a network company. It is also a recurring revenue company. That matters because the company is no longer just getting paid to launch things for other people. It is building and operating its own constellation. It is selling internet access. It is selling service. It is selling capacity. It is selling a utility-like product with monthly or enterprise-style billing. That is a massive shift because the rocket is no longer only a product. It becomes internal infrastructure. Every launch can support the growth of a future cash-generating network. That is why Starlink is such a powerful example. It changes the meaning of a launch. A launch is no longer just a delivery. It is an investment into a service business. Why investors keep funding losses. This is one of the most confusing parts for outsiders. Why do investors keep putting billions into space companies that may not be profitable for years? Because they are not buying this quarter. They are buying future dominance. They are buying strategic positioning. They are buying recurring revenue potential. They are buying infrastructure. They are buying contracts, scale, and the chance that one company becomes the standard platform in a very large market. That is the logic. And it is why many space companies are valued on future possibilities instead of present profits. Traditional businesses are often valued on earnings today. Space companies are often valued on the possibility of owning a system tomorrow. That is why the money keeps coming in. The bet is not, are you profitable right now? The bet is, will you become essential later? The danger of capital intensity. But there is a dark side. The more ambitious the company, the more capital it consumes. Factories are expensive, launch pads are expensive, testing is expensive, reusability is expensive, regulatory compliance is expensive, building satellites at scale is expensive, deploying a constellation is expensive, supporting customers is expensive, and all of this happens before the company gets to the point where the business starts throwing off reliable profits. This is why space companies can look like growth stories while actually being cash-burning machines. Revenue is not the same as profit, and profit is not the same as free cash flow. In space, those differences matter a lot. A company can have impressive top-line growth and still be dangerously fragile underneath. That is why cash runway becomes so important. Not just whether the company is growing, whether it can survive long enough to monetize that growth. Government contracts are not just revenue. Government contracts are often treated as a boring part of the business. That is a mistake. They are not boring. They are strategic. A government contract can do three things at once. It can bring revenue. It can validate the technology. It can make future fundraising easier. That is a huge advantage, because when a serious institution pays you, investors notice. When a defense agency, a space agency, or a major government customer chooses your company, the market reads that as credibility. That credibility can unlock more funding, more partnerships, and more customer trust. In a sector where reliability matters, government contracts are often worth more than just the number on the invoice. They are a signal, and signals matter. Why reliability is worth money. A lot of space economics comes down to one simple fact. Some missions can tolerate failure, some cannot. A consumer product can break and be replaced. A classified payload, a national security satellite, a weather system, a communications backbone, or a critical navigation asset is different. If failure is unacceptable, the buyer is willing to pay more for confidence. That is why launch price is not the only factor. Reliability has a price, mission assurance has a price, security has a price, schedule certainty has a price, and the companies that can consistently provide those things can win business even when they are not the absolute cheapest. That is a major economic truth of the sector. Low price is good. But in space, trusted execution can be better. The launch business is not as simple as it looks. A lot of people imagine launch providers as if they are just selling rides to orbit. But launch is a weird business. It has long lead times, huge fixed costs, very high technical risk, and a reputation problem. One failure can affect the next several deals. A launch company does not simply compete on cost. It competes on trust, history, schedule, cadence, and the ability to deliver without drama. That means the launch business is not just a manufacturing business. It is also a confidence business. The buyer is not just buying propulsion. They are buying reduced uncertainty. That is why launch cadence matters so much. The more often you fly, the more data you generate. The more you fly, the more trust you build. The more trust you build, the easier it becomes to win future business. In space, flight history is a financial asset. Why satellite businesses can be better than rocket businesses if you had to choose between a company that launches satellites and a company that monetizes satellites. The second one is often more attractive. Why? Because launch revenue is episodic. Service revenue is continuous. A rocket company may get paid once per mission. A satellite service company may earn income every month for years. That is a giant difference in economics. It affects margins, it affects valuation, it affects fundraising. It affects how much patience investors need. This is why Earth observation, communications, navigation services, defense intelligence, and broadband are so important. They turn space hardware into an ongoing business relationship. The best space companies do not just put things in orbit. They make orbit useful. The hidden importance of backlog. Here's a concept investors obsess over. Backlog. Backlog is the list of future work already booked. In space, backlog is a huge deal, because a big backlog means the company has visible future revenue. It does not guarantee profit, but it reduces uncertainty. And reducing uncertainty can make a company look much stronger to lenders, investors, and partners. A launch provider with years of booked missions has a very different risk profile from a startup hoping the market appears later. A satellite operator with long-term contracts looks far more stable than one depending on spot demand. Backlog is not just a spreadsheet item, it is a survival indicator. Why some companies stay private longer. A lot of people ask why some space companies remain private for so long. The answer is control. Public markets are impatient. They want quarterly numbers, they want margin discipline, they want visible progress. But space often requires long development cycles. It needs capital before it needs applause. Private markets can sometimes tolerate that better. That allows founders and early investors to pursue infrastructure-heavy strategies without constant public pressure. The downside is that the company must keep convincing private investors to keep funding the mission. So either way, the discipline is brutal. But private ownership can buy time. And in this industry, time is often the difference between scaling and failing. Why valuations get so extreme. Some space companies get valued at enormous numbers despite limited profits. That is not always irrational. If investors believe the company controls a strategic platform, has recurring revenue potential, owns critical infrastructure, or can dominate a high-growth market, they may value it far above current earnings. That is especially true if the company has strong government ties, proven launch capability, recurring subscriptions, vertical integration, and a pathway to large-scale market share. In other words, investors are not only valuing what the company is today, they are valuing what it might become if everything works. That is why space can produce eye-watering valuations. The upside is huge, the risk is also huge. Why vertical integration matters. One of the most powerful ideas in space economics is vertical integration. If a company can build the rocket, build the satellite, launch the satellite, operate the network, and sell the service, it captures more value in the chain. That does two things. It reduces dependency on outside vendors, and it gives the company more control over cost, schedule, and margin. That is a big deal, because every outsourced layer can add friction, delay, and cost. The more of the stack you control, the more strategically powerful the business becomes. That is why some of the most admired space companies are not just launch companies, they are systems companies. They own more of the workflow, they own more of the economics, and eventually they may own more of the customer relationship too. The real risk nobody loves talking about. Most people think the biggest risk is a rocket explosion. That is a risk. But it is not always the biggest risk. A bigger risk is cash exhaustion. A company can survive technical setbacks if it still has money, trust, and runway. But if the money runs out, the dream dies, whether the engineering is good or not. That is why so many founders in this space are obsessed with financing. Not because they love fundraising, because fundraising is survival. The company that survives long enough to prove the model can become enormous. The company that cannot bridge the gap never gets the chance. That is the brutal truth. Space is becoming infrastructure. This is the big picture. The space economy is slowly moving from a pure exploration mindset to an infrastructure mindset. It is becoming about connectivity, about data, about recurring access, about defense utility, about logistics, about service layers built on top of expensive hardware. That is why the industry has become more interesting to investors, not because rockets are cool, because space is becoming embedded in everyday economic life. Phones use positioning, airlines need connectivity, governments need intelligence, ships need links, remote industries need coverage, disaster response needs communication. And all of that creates monetizable demand. The more embedded space becomes in daily infrastructure, the more durable the economics become. So what are you actually buying? Now we can answer the real question. If you buy a space company, what are you buying? You're buying technology, you're buying contracts, you're buying credibility, you're buying infrastructure, you're buying launch capability, you're buying recurring revenue potential, you're buying government trust, you're buying optionality. And if the company is good enough, you may be buying a platform that keeps compounding value long after the first rocket ever flew. But you're also buying risk, long development cycles, high burn regulatory pressure, technical failure, schedule slips, competition, and the possibility that the money runs out before the scale arrives. That is the trade space, is not a normal industry. It is a high-stakes bet on future infrastructure. The winners are not just the companies that can reach orbit, the winners are the companies that can turn orbit into durable economics. That is the real business, that is the real money. And that is why the smartest investors in space are not just asking who can launch. They are asking who can survive, scale, and collect for years after the launch is over. Because in this industry, the rocket is only the beginning. The company that owns the economics after liftoff is the one worth paying attention to.